TheoTrade. This is Don Kaufman. February 5th, 2021, doing the TheoTrade weekend update here on a Friday afternoon. Buy the squeeze, sell the skew. I'm going to explain in quite some detail here in a bit of a strategy session in a few minutes regarding, well, what exactly that happens to entail. But let's give you kind of a quick market update here to kind of kick off this weekend's update. And that is nothing less than an explosive move up that really just decimated volatility. In fact, this is one of the fastest, contractions of implied volatility that I have seen in a considerable period of time. And it was kind of through and through. First and foremost, if you take a look at the S&Ps, and in this case, we'll just look over at the spiders. After the previous week, some pretty harsh sell-side activity met by what? All-time highs! The S&Ps explode back onto the scene, and again, it decimates volatility, which is probably one of the more important things from a option kind of strategizing standpoint, because it's opening up some seldom seen kind of strategies are really opening up. And again, in a moment, we're going to talk about, buying that squeeze and selling the skew. And again, I'll explain in just a moment here. But when you take a look at this, what really stands out in terms of the S&Ps, we could talk about the QQQ, we could talk about the IWM, and we will in a minute. What stands about the S&Ps was just earth-shattering moves in terms of the weekly expected move, and then really the occurrence of how large we actually breached through some of the expected moves. And this is something I actually talked about quite a bit throughout the course of the week. But what we basically have right now is 2 consecutive trading weeks onto which we've actually kind of shattered through the expected move. Now, for those of you, if you're maybe aware, maybe unaware, what the expected move kind of breaks down to. And this is something I typically kind of save for the end of each one of these weekend updates. But it's on the forefront of what's going on right now. And we're going to strategize around this here in just a moment. What I'm getting to, though, with the S&Ps is that in this previous week of trade, and again, the week we just passed through, right? We were looking for approximately $132 move. Now that's a $132 move higher or lower. Okay. How did you come up with $132? The option market depicted the risk. So we had an increased implied volatility, right? Following, again, some sell-side activity, even the week previous to that. So some sell-side activity drives volatility higher. The higher volatility expands out the expected move. Actual move in the markets, 169 and change. I mean, we literally shattered through it. And it doesn't matter. Like, people go, oh, it wasn't to the downside. No, it was to the upside. Okay? I mean, you're getting upside volatility. And, people keep using these terminology like it's a gamma squeeze. And maybe they're familiar with that. Maybe they're not. Gamma squeeze can, in fact, happen both to the upside and to the downside. In this particular case, though, it was a rip and squeeze to the upside. And again, almost 170 points worth of S&P movement to the upside. Now, before I go any further than that, as I said, there's 2 consecutive weeks where we actually breached the expected move. You go, oh, so what? Like, well, what does that matter? What this is actually saying about the marketplace. So, if it's like 1 week, all right, it's just it's kind of an odd week. We broke through it. 2 consecutive moves, though, of this magnitude. And you start to think to yourself, the marketplace is actually, some of the efficiency is starting to break down. It's actually what I kind of call short-term inefficiency is in play. One of the things that we have seen, and we've actually studied, okay, is consecutive breaches. Again, consecutive breaches of expected move have tendency to lead to even more breaches of expected move. It means basically like volatility starts to get a little bit out of hand. And again, the interesting thing about this is, though, that volatility, it was out of hand this last week. I mean, $132 move, that's, put on your big boy pants. That's a big move. And we still shattered it, right? So you have tendency to see consecutive moves like this. And you can actually go back and here we'll have open up like the last 3 years, and you go through these periods, and I was talking about this earlier in the week of wild efficiency followed by all of a sudden we start shattering expected moves. Now, granted, this move down that I'm actually pointing out, yes, that happens to be entering into the Corona, kind of a sell-off. Nevertheless, we actually studied this in many different types of marketplaces. And one of the interesting things to point out, here's a breach to the downside, then a rip and breach to the upside, then a rip and breach to the downside, another one to the downside. Again, consecutive breaches of expected move have tendency to lead to more breaches of expected move. Now, it's one of the reasons I wanted to bring this up at the forefront of the discussion, because here is a marketplace that, everybody's looking at it, and no matter how long you've been doing, involved in trading and, involved investing and doing this in general, there are still moves. One of the things that keeps me interested in this business is there's still moves that you just like, it's awe-inspiring. I mean, if you look at the spiders, it's a pretty ripping move. Again, and a year-to-date percentage, the spiders are up some 5%. You realize that the S&P, its move just, paled in comparison to what? The IWM. The Russell, you realize the Russell is up on a year-to-date basis. I mean, this is an entire year's worth of movement. In a month, I mean, legitimately, it's even less than that here. If you want to just look literally like, this week, it's almost 6%. Now it's up like 14%. I mean, people, these are like once in a lifetime types of moves that you're seeing, right? That, people, is unequivocal. It is a gamma squeeze if I have ever seen one before. And I have got the strategy for that because, well, I've got a gamma iron on in there, which I'll actually detail here momentarily. 14% though on a year-to-date basis. Meanwhile, the QQQ is also kind of lagging, only up 7%. Huh? When was the last time you thought you'd actually be talking about the IWM smoking the QQQ? And here, I'm telling you, this is advantageous. You got to look at this as, I mean, these kind of moves, as I said, once in a lifetime type moves. This is an index product. Okay. Again, the IWM is trading 150. It's a couple of weeks ago. It's now trading 70 points higher. When you start to put that into percentage terms, and again, the year-to-date percentage is 14%, but, knock this back on a one-year chart. Here's a product that just a few weeks ago was actually down 9%. Basically on a one-year basis, it was down about 9%. It's now up some 32%. And we're looking at, again, staggering moves, 40+% moves in a major index product. And again, the reason that I'm bringing this up, I call this short-term inefficiency is in play right now, which has a lot to do with what I'm terming buy the squeeze, which you're going to go into that here in just a moment. Before I get there, make a couple of other points. All right. So I've also mentioned that an explosive move to the upside, it decimated volatility. So you got to go take a look at VIX. So we've seen some crushing moves inside of volatility, but recently here, this is a crushing move inside of volatility, and let's actually normalize this particular chart. But this is a crushing move in volatility. But to get all the way back down to the 20 level, I mean, you're looking at weeks in here. This is a crushing move in volatility that literally took us from 36 right back down into the 20 handle in what? A couple of trading sessions. It's 5 trading sessions. 5 trading sessions. It is one of the fastest declines in terms of the VIX that we've seen really in recent history. Again, we spiked. It's all over, and it's not just in the VIX. If you look at like what's termed contango and backwardation, you look at the volatility futures. The volatility futures, front month vol futures, which have 12 days to go, dropped all the way to 24. I mean, these things were coming close to like what? Again, you have to look at this. These things are up in the mid 30s. It hit 36. Okay, for a very brief and fleeting moment. These things were 36. All the way back down to 24, and you look to some of the back month, right? We had volatility futures, late last week that looked like this. They were completely inverted. Now they look completely the opposite, like that. And again, I think you have to look at this as a little bit of opportunity, which, as I said in a moment, I'm going to be bringing that up when I talk about buy the squeeze, sell the skew. All right. So again, volatility gets decimated and it's through and through. Even the VVIX, the volatility of the volatility index, it's out of the VAMA zone. It's a brief and fleeting moment though. I mean, listen, out of the VAMA zone. The VAMA zone is anything north of 110. Anything north of 110, I mean, it's serious. Like volatility is rocking out there. Here we are back down to a 107 in terms of the VVIX. And what that basically means is that options themselves in the VIX product are lower price. It's cheap relative to where they were just, 5 trading sessions ago. And again, 5 trading sessions ago, you had a VVIX, and I just want to clarify this because, behold, the VVIX almost hit 170. 170. It collapsed all the way back down to 107. So you can actually look at the VIX options as, well, inexpensive relative to where they were. But I'll tell you something, there was no real volume trading in here. Okay, the only things, seeing some volume out there, okay, were ultimately, well, a handful of products, some of the usual suspects. All right, so again, in this, we'll come back to it in just a moment when we talk about specific strategy. Now, before I get there, I want to talk a little bit about rates. So interest rate. Interest rate, of course, is associated with the bonds. There's really a handful of products in this marketplace right now that I'm kind of bothered by some of the price action in. And, I know that a lot of people want to come up with different ideas about, why the bonds are actually selling off over here. So why are the bonds selling off? Okay, because bond selling off is going to take rates, that interest rate higher. Okay, and we're going to look at a moment at TNX. And TNX is just soared, right? So as the bonds and the notes sell off, the interest rate associated with that absolutely is soaring. And of course, people are going to tell me, well, it's the $1.9 trillion package. The economy is getting back on pace here, except the jobs number came out today. Jobs number, what was it? Okay. Yada, yada, yada. It was nothing. I mean, it wasn't even worth mentioning, the jobs number because it was nominal. It was a positive jobs number, basically hit like the target out there, but it was really, really nominal, the jobs number. So this has a lot to do possibly with the stimulus package coming out. And, maybe the threat of inflation. But then what doesn't make sense if this is a threat of inflation coming throughout the course of this week and the last couple of weeks, a lot of traders have actually rushed into the dollar. So if you're worried about, inflationary pressures, or you're worried about, again, for the most part, all of this stimulus devaluing the dollar, why are they buying the dollar? Obviously, today there was some sell side activity inside of the dollar. But again, this trade where they're selling bonds and possibly buying dollar has got me perplexed. The one thing I can tell you, though, okay, without unequivocation, the one thing I can tell you about this is, well, if you take a look at the TNX, and again, that's exactly where we're going to head with this, is rates. So the interest rates are exploding. Now, this is the interest rates exploding on the 10-year. And this is back in August. By the way, if you've never read this before, I know it's 5. It wasn't 5%. It's, it's like 0.5%. All right. So that's the 10-year interest rate. Now that rate is sitting closer to what? It's very close to 1.2%. So you can say, for the most part, it's beyond doubled. I mean, again, and if you are servicing debt, if you're the Treasury and servicing debt, and that debt is now $27 trillion, all of a sudden when you start rolling that debt over, that debt, for the most part, just to service the debt now is costing what? Well, 100% more than it was. So it's not necessarily a good thing inside of the marketplace. The other aspect is the yield curve has just really, really steepened. What you're actually looking at here is a comparison chart. I just set this up prior to, but it's a comparison chart. It's the TNX versus the TYX, right? So it's actually the 10-year versus the 30-year. And they talk about like the yield curve steepening, and it's, scare me. Basically what it means is right over here, okay, is your 30-year. And over here happens to be your 10-year. And you can see they're becoming divergent. When they talk about the yield curve steepening, okay, the 30-year has gone up more, for instance, than the 10-year. So they're literally starting to diverge. That distance is getting what? Okay, larger, so it's actually steepening the yield curve. And when they talk about steepening the yield curve, predominantly and historically speaking, that has kind of meant like, reflationary trade, the economy is getting a little bit better, or for the most part, my take on it might be that debt is just getting completely out of control and the marketplace is trying to get ahead of it. So what are they doing? Selling bonds. Nobody wants their hands on bonds. But again, the dollar has me a little bit perplexed, and I'm not going to sit here and give you, 50 ideas of why this could be going on. But I will tell you one thing. If these bonds continue to sell off, I'm actually going to start selling puts inside of the bond product itself. So, and I'm going to go a little further out in time. I might go as much as like, 49 days out, and I'll be out here selling some way out of the money puts. Listen, even if I got put the bonds themselves at like 158, bring the pain, because I'm down with that. I think that could be a wonderful opportunity out there. So now we're going to get into a little strategy discussion just for about 5 minutes or so, and this is something I'm going to elaborate upon considerably. So one of the things that I have actually been back into a lot lately, and this is something I haven't done in a lot of years, I'm back and I'm selling quite a bit of premium. And I'm selling premium for a number of reasons, okay? So there are a lot more opportunities in this marketplace than I've seen in years in terms of selling premium. Some of the implied volatility skews have actually flipped over in some of our most beloved products out here. I mean, you look at stuff like Apple, and I'll just bring up an underlying. By the way, I didn't check this out even prior to, but you look at something like Apple, go out and like open up an option chain. When you open up an option chain inside of something like Apple, and I'm just opening up 42-day options and kind of just know off the top of my head, look, 42-day options, forget about Delta for a second. Look at the implied volatility. At the money, implied volatility is like 32%. Out of the money, implied volatility actually goes up on the calls, right? So the skew is just wild right now. I mean, calls are skewed like puts have been skewed. See, the way that options have worked, kind of like historically speaking, the way that options have worked is that when you look at the differential between calls and puts, historically speaking, it looks more like, even in a product like Apple, it should probably look more like the spiders. When we start talking about things like skew, what I'm trying to point out here is that the out of the money puts, here's some out of the money puts, and again, we're 42 days out, and they're trading for like 22%. And then you look at the out of the money calls, and I'm not even going to scroll out. You look at out of the money calls, they're trading for like 15%. That's normal, right? Because the risk in the marketplace is predominantly to the downside. Like everybody's like, oh, there could be a crash. There could be. And if there's a crash, okay, that's why those puts are trading for so much more than these calls. And it's been like that ever since the crash in 87. Skew was kind of negligible up until like 1987. The puts were pretty much trading for the same, amount as calls until, of course, the marketplace crashed. All of a sudden, though, you start looking at equity products. And again, I bring up Apple. That's just a marquee underlying, but I bring up Apple. And if you look at the out of the money, and again, if you look at these out of the money puts, okay, they look pretty much similarly to the calls. So the marketplace right now, and again, behold what you're seeing over here. This is, the 110 puts. The 110 puts are trading at a 40 vol. What are they? $20, $30 out of the money, whatever. Okay, so go out of the money about equidistant here. I don't know, come up here to the 160, 155s. I mean, the implied volatility is almost the same. The way the marketplace is pricing right now, like a crash to the upside in Apple is almost equivalent to a crash to the downside in Apple, which really makes absolutely no sense, right? Then you bring up something like Tesla. Now, Tesla had like a proverbial crash to the upside, and they continue to do this and stuff, like even go 70 days out inside of Tesla. Let's get crazy. Go some 70 days out. You look at way out of the money puts in here, like the 400 strike puts. Okay, and they're trading for like $3-4. Okay, that's about what, $450 out of the money. Go way out of the money. Okay, I'm all the way up here, and I just want you guys to see this. I'm up here at what? There you go. That's the 1700 strike. Oh, don't worry, this thing would just have to double in price, and they're still trading for over $4. You want to talk about some skew? That's some skew. Okay. There is huge skew in the marketplace, and it is becoming advantageous. So one of the things that I'll tell you that's really working right now is what we call buy short-term gamma, sell long-term premium and skew. Okay. And what that kind of breaks down to, and again, I've been doing it in the TheoTheo portfolio already. I just haven't really elaborated on it too much, but I'm doing it in the TheoTheo portfolio. Let's go over to the IWM, and I'll actually show you. This is what we call a gamma iron condor. A gamma iron condor, and I've got other positions in here, so I'll kind of try to hide those a little bit. What the gamma iron condor is doing is I'm actually purchasing a call spread and simultaneously purchasing a put spread. All right, so I'm on both sides of the marketplace. So I'm buying a call spread and buying a put spread. Why? Because in the short duration, and this is not that short, right? It's 42 days out. Okay, in the short duration, the moves, if you look at like auto expected move, the moves are explosive. All right, the moves are so explosive, we continue to kind of shatter through the edge of the expected move. So if we're continuing to shatter through expected move, or we're seeing these wicked and violent moves outside of what's expected, we could probably be profitable, okay, buying iron condors, not selling iron condors. So in the short term, we're actually buying, okay, the gamma. Why are we doing it in the short term? Because that's where these gamma squeezes are in the shorter term. Now, I'm giving myself 42 days, just enough time to be profitable. In the meanwhile, I'm actually selling back month premium. Why? Because the back month premium, okay, the back month premium, when I'm talking about back month premium, I'm talking about a little bit longer dated options, right? This still has decent amounts of volatility. I'm a little far out over here, but you can actually see I've got positions 70, even 105 days out, 30% IV and so forth. There's still great amounts of decay out here. That's one of the things that people do not understand. Don't ever let anybody tell you. And again, from a strategy point of view, don't ever let anybody tell you. Options decay, okay, very quickly the closer you come to expiration. That's true, but that's actually closer to the money options, at the money options. I'm actually out here selling out of the money options, and out of the money options, okay, on an option from like 105 days out, we'll lose about 50% of its premium between 105 days and 70 days, okay? In fact, I'll kind of prove it to you. All you have to do is open up the 105-day options, close up this left side bar. I want you to look way out of the money here. Go look at like an 11 delta option, 10-11 delta. Look, here's the 260s. Okay, this is the 260 calls. Don't even worry about the puts right now. Look at the 260 calls. Those 260 calls are trading for what? Let's call them $1.50. Just work off the ask, right? They're trading for $1.50. Now, what would this option be worth? The 105-day call. What would it be worth, okay, if there was only 70 days left? Well, go look. Okay, here's the 260s. There's 70 days left. Look, they're trading basically 65 to 70 cents. So what did we say a moment ago? Okay, what were they trading for? Oh, about $1.50. What are they going to be trading for? What? Okay, just from 105 days down to 70 days. This is just a 35-day burn. And this is the thing that just really gets me, because people are just convinced I should sell shorter term options. Really? Because there's unbelievable amounts of decay out here. Okay, that's a burn of 50% in 35 days. 50% of the option, 35 days, and I do not have negative gamma risk. No negative gamma risk involved in there, right? They're easy to mitigate. How do you actually control exposure of these short options? Okay, by actually buying shorter term options. So this is not necessarily for the faint of heart. And people are like, he's selling options naked. Not really. I've actually got what we term inside hedges. But if you don't have the margin to be able to sell options naked, we can show you how to sell options naked. It's actually one of the things I'm going to be talking about a tremendous amount in the very near future. We're even going to have a full-blown class that is coming on February 23rd, 24th, and it'll describe a lot of these tactics over here. In fact, most of those tactics are already in play inside of the TheoTheo portfolio. With that, again, I wanted to do a little bit of a strategy session, because what you got to understand right now, we're going to buy the squeeze, and we're going to sell that skew. We're going to actually sell some longer term premium and sell some of that skew out there. Listen, again, one of the things that really sticks with me in this marketplace, and I'll stress to you, is, again, the sheer magnitude of the moves that we've seen. Okay, the last thing I want to leave you with, the last thing I'm going to leave you with here on this weekend update, you just saw, okay, this was, about a $73 expected move. Okay, that's 2 weeks ago, right? So that's a $73 expected move. It gets shattered. Okay, then we see $132 move. It gets shattered. Then they collapse the volatility all the way down to $63, plus or minus $63 this next week. Okay, it's a full trading week. $63 expected move. Look, okay, for continued volatility this next week. All right, whether it's to the upside or the downside, it doesn't matter. Understand now why I'm buying short-term premium. I'm buying short-term premium to look for this move to get shattered. Again, contracting volatility this much after 2 consecutive weeks of shattering through the expected move looks like it is a premium buying opportunity. Meanwhile, in the longer duration, I'm actually going to be selling some of the premium out there. Hope that makes sense. Again, I'm going to be talking about it all throughout the course of the week here on TheoTrade. Thanks, everybody, for joining us here for the TheoTrade Weekend Update. Have a wonderful weekend. Bye-bye.